Hey everyone, welcome back to another episode, and today we're going to be talking about which one is better. Which one should you invest in? Should you buy individual stocks, or should you buy some sort of an index fund or an ETF? And as always, if you find this content useful, be sure to give a like, leave a comment down below. It really helps out the YouTube algorithm to help channels grow. So let's get into it. But before we do that, I think we all need to get on kind of the same page and just give a real brief explanation of what an ETF actually is. So we're all pretty familiar with individual stocks. You know, you want to go out and buy Walmart or Amazon or whatever individual company you want to buy. But what exactly is an ETF? Well, an ETF is just an acronym. It stands for an exchange traded fund. And basically what it is, there was a professional money manager, and they put together sort of a basket, a portfolio of funds, and you can then easily purchase this basket of funds on a stock market just as easily as you would purchase an individual stock. Now there's many different ETFs, and they all attempt to track some sort of a benchmark. For example, Vanguard's VOO is an ETF that attempts to track the S&P 500, which is essentially just the 500 largest companies that are traded in the United States. But you could just as easily buy a different ETF that specializes in the energy sector or retail, raw materials. Whatever it is, if you're interested in a category of products, there's an ETF out there that will fit your needs. Now, when trying to evaluate which method is better, buying individual stocks or buying an ETF, we need to first realize that there is no clear-cut, universal answer. It all is going to depend on your particular investing strategy and your particular confidence in being able to pick individual stocks. But hopefully we can at least identify some of the pros and cons associated with each product. That way you can attempt to better tailor your investing style based on your needs. So with that said, let's attempt to break down some of the fundamentals and kind of keep a running tally, a scorecard, if you will, to better illustrate which product might be better for you. So the first thing that we're going to look at is diversification. You know, a lot of people say that you need to be well diversified. That way you're not putting all of your eggs in one basket. That way if this one particular company fails, you don't lose all your money. You kind of spread that risk around. And so obviously if you're just going to buy an individual stock, you know, you are putting all of your money in that one stock. Now you might purchase a couple of different stocks, you know, instead of just purchasing one, you might purchase, you know, 3 different ones or 10 different ones or whatever the case may be. But ultimately, you're still limited to those 3 or 10 stocks or however many it is that you bought. On the other hand, an ETF, by its very nature, is already diversified within the sector that it is attempting to track. So when you are buying stock in the VOO, that Vanguard's S&P 500 ETF that they have, you are buying small shares in 500 different companies. So immediately you are automatically well diversified. So in this case, it makes complete sense that we give the tick mark to the ETFs as the clear-cut winner when it comes to overall diversification. So the next thing we're going to look at is going to be dividends. You know, a lot of people like dividends. You know, it's kind of that annual or quarterly payout to investors for owning shares in this company. You know, they return some of the revenue that they generated in the form of dividends back to you. And this can help create a nice passive stream of income for people. So a lot of investors really like dividends. So obviously when you're trying to pick an individual stock, surely you can pick a particular stock that has really high dividends. So it makes sense to be able to give a check mark here to stocks because, you know, when you're picking one stock, you can simply just look down the list, see which one pays the highest dividends, and go with that one. However, when we're looking at the stability of those dividend payments, I think we have to give the advantage to the ETFs. while the overall dividend rate might be slightly lower with an ETF as opposed to the individual stock, since you are purchasing that one singular best stock, with the ETFs, you're going to have a more stable dividend product, because theoretically that one particular stock might pay really good dividends because the price has recently tanked on this particular stock, and the last dividend payout was still pretty high, but they may not be able to sustain that high dividend payment quarter after quarter, year after year. Whereas with an overall basket of funds, the stability of those dividend payments is going to be much improved. So I think we also have to give a check mark here to ETFs. So the next category we're going to be looking at, well, it's actually going to be two categories because they're basically going to be, have the same prerequisites. So we're going to be looking at growth rate as well as value investing. A lot of people like to invest in growth stocks, for their long-term growth potential. Maybe they're, companies that aren't quite profitable just yet, but their growth rate, their potential in the long run is really high. Companies maybe like Uber or Lyft that are currently losing money every month, but if they are able to stabilize and get their product off the ground, they could easily be a massively profitable company. And the same thing goes with value investing. Maybe a particular stock is undervalued, and so you're just able to kind of sneak in and get it for a good price. So obviously you're going to be able to do both of these things with a particular stock. With proper research and identification, surely you can, find individual stocks that fit either your growth or your value investing needs. So obviously a stock is going to need to get this tick mark. But once again, you can also accomplish the same thing with an ETF. Now, you might not get quite as much growth or quite as much value with the ETF, but the stability of that growth and value is going to be much higher. You might have a particular industry, we'll go back to Uber and Lyft, maybe one of those two companies is going to take off and the other one eventually goes bankrupt. Maybe it has poor decision making, bad CEO, poor marketing, whatever the case may be. So when you are diversified, it kind of eliminates that, and so your overall growth and your overall value investing is going to be much more stable. So I think it also makes sense in this case to give a tick mark as well to the ETF side of things. And lastly, risk. When you're picking an individual stock, theoretically that stock price could shoot through the moon and you can make a whole lot of money. But on the flip side, it could also go bankrupt and you could lose all of your money. Now, a lot of people say that you just need to properly pick and plan your stocks, but that can't always be the case. Enron was a very prominent company back in the 80s and 90s, up until about 2001, when it came to light that they were just a giant fraud. They were cooking their books, and instead of being wildly profitable like they claimed, they were actually bankrupt. So even with proper planning, there is still a lot of risk involved in trying to pick individual stocks. Now, it should go without saying that ETFs also have risk associated with them as well. There is not going to be a risk-free investment. That simply does not happen. But because they are automatically diversified, an ETF is going to have a much lower risk value than an individual stock. So in this case, I think the clear winner in this situation is going to be the ETF. Now, if we were going to be looking at our total scorecard here, the tally, it should be pretty clear that ETFs are going to be the overall winner when it comes to which one is going to be better, stocks or ETFs. And for the most part, I would tend to agree with that. If you are the average investor that's trying to put some money away for retirement or trying to, just be financially independent and responsible, then I would highly recommend an ETF without knowing anything about you or your background or what your financial knowledge is. I would say the ETF is the perfect investment vehicle for probably 95% of people out there. But one of the drawbacks of an ETF, since it is purchasing so many different companies within a particular sector, by its very nature, there's going to be a combination of different outcomes. You know, some of those individual companies that are owned within this ETF are going to be winners, and some of them are going to be losers. So you're going to get the good with the bad, and theoretically, it's just going to all average out, and you're going to get a nice, good, solid rate of return. But what if we could eliminate a few of the losers out of this group? Or at least identify a couple of the winners in this group. If we're able to do either of those two things, then our overall rate of return is going to go up. And also when it comes to picking individual stocks, I think it should be, pointed out that everybody that picks individual stocks thinks that they're really smart, and they think that they know what's going on, and they think that they have a pretty good idea of which stock is going to do well and which one is not. But realistically, most investors that attempt to beat the market actually fail and underperform. So theoretically, if you were to instead put your money in one of these ETFs and at least matched the market, broke even with the overall market, that means if most investors underperform and do not meet the average returns of the market, then by default, you are going to overperform versus most investors. So if you found content like this useful, be sure to give it a thumbs up, leave a comment down below, and subscribe. It really helps out the YouTube algorithm to be able to push content, educational content like this, out to more and more individuals. And as always, I'll see you all again next time. Thanks.